Niall Ferguson, The Ascent of Money, A Financial History of the World. Dive into the fascinating world of money and finance as Niall Ferguson's The Ascent of Money, A Financial History of the World unravels the story behind the development of the financial system we know today. Explore how the value of money is based on trust, the invention and impact of credit and debit, and the evolution of various financial institutions. Through the book's summary, you'll also gain insights into accessing credit as a path out of poverty, the ups and downs of the stock market, and the consequences of political decisions on the financial world. All of this is presented in a captivating and easily digestible manner, enlightening readers about the crucial aspects of the global financial system.
The power of trust in money. In the 16th century, Spanish conquistadors sought gold and silver to mint coins and increase their wealth. However, the surge in coinage led to the depreciation of its value, revealing that the power and value of money come from societal trust, not physical worth. Money is not valuable because of its intrinsic properties, but rather because people believe in its value. The trust embedded in money also involves central banks ensuring a stable supply of currency while banks protect customers' assets. In contemporary society, most money is virtual, with paper bills and coins largely worthless without societal trust in their value. The value of money, therefore, derives from the trust placed in it by society. The evolution of credit and debit. The advent of credit and debit has been pivotal to human progress, standing alongside scientific and technological breakthroughs. Initially, borrowing and lending were prevalent in ancient Mesopotamia, evidenced by inscribed clay tablets. Over time, developments in banking transformed this simple process into the credit system in use today. Banks play a critical role in this system as they create credit, which expands the money supply. For instance, depositing €100 in a bank could result in €270 being created through lending and relending. This monetary expansion is significant as the money generated can be employed to fund investments/purchases. The credit and debit system is indispensable to finance since the supply of money would decrease without debtors and creditors. Development of the modern financial system. The modern financial system is made up of various interconnected markets and institutions that were developed over the centuries. It started with the creation of banks in medieval Italy, as merchants needed credit to fund their trade. The bond market was then invented during the constant wars between Italian city-states, which led to the sale of government IOUs on the market. In the 17th century, joint stock companies emerged, allowing companies to fund themselves by selling shares of ownership on the stock market. In the 18th century, insurance companies used financial market analysis to manage risk. Governments greatly expanded their role in the financial system in the 20th century. Finally, the real estate market was heavily expanded in the 1920s through government deregulation and incentives for political reasons. These markets and institutions are all interdependent and make up the modern financial system that we know today. The truth about financial systems. The financial system, which includes banks and access to credit, provides the best route out of poverty. Despite negative stories about greedy bankers, banks allow savers to deposit money which can be loaned to those in need. Access to credit provides people with a chance to make long-term plans and decisions, such as buying property or starting a business. Without access to reliable credit, poor people are forced to borrow from less reputable sources, where astronomical interest rates and violent punishments for late payments are charged. Microfinance, which lends small amounts to individuals with little or no collateral, can fund expensive items or help start microbusinesses. With access to affordable credit, people in poverty can make a dramatic difference in their lives. The power of efficient financial systems. Inefficient financial systems, such as communism or feudalism, restrict the free flow of capital, making financial development challenging. In contrast, the financial system in Western Europe allows for the freest and most efficient flow of capital, making competition fierce and driving profitability and reliability. This system has allowed societies using this model to prosper and dominate over those with inefficient financial systems. The spread of the Western financial model continued through globalization in the 20th century. Historical examples such as the rise and fall of European empires and the domination of Western nations over Asian countries illustrate the power of strong financial systems. The Netherlands, despite being smaller, outperformed the Spanish Habsburg Empire economically due to its efficient financial system. In conclusion, societies with a strong financial system will prosper at the expense of those with financial inefficiencies. The flawed financial system. The financial system is a reflection of human nature, which is inherently irrational and unequal. Humans tend to swing between different moods, making us more irrational where money is concerned. Investor confidence is fragile and easily affected, leading to unstable markets. Additionally, people prefer to observe and copy others, contributing to market instability. Financial rewards are not shared equally, and inequality lies at the heart of both the financial system and the human condition. These irrational faults and inequalities in human society are intensified in the financial system. The danger of stock market bubbles. The stock market is like a balloon that inflates when confidence is high and deflates when it is low. However, sometimes the market inflates too rapidly, and a stock market bubble forms, which can lead to dramatic price falls when it bursts. Investors are often surprised by this phenomenon and lose substantial amounts of money. There are many reasons why bubbles develop and why people fail to recognize them, including short financial careers, unscrupulous executives, and insufficient understanding of the financial system. When people are lured in by tales of high profits and growth, unsustainable growth in the market occurs, leading to devastating losses for investors. It is important to understand the dangers of stock market bubbles, which are a relatively common financial occurrence that all eventually burst. The perils of hyperinflation. Inflation is expected, but hyperinflation is dangerous, especially for those holding government bonds and savings in a particular currency. Hyperinflation results from the mismanagement of a nation's currency and monetary system. It carries far-reaching, negative effects for society, destroying the wealth of domestic creditors and savers while also weakening the credibility of the currency. The responsibility for this phenomenon lies with the central bank or government, making its root causes political. Hyperinflation can be a deliberate way for a government to wipe out its domestic debts, or it can result from bad government policy stemming from political instability or the failure to solve long-term central economic problems. The power that states ultimately hold over the financial markets is demonstrated by hyperinflation, but it also shows the dangers of trying to fight against the market. The evolution of insurance and the welfare state. In the 18th century, two Scottish Protestant ministers created the first insurance scheme by pooling premiums and investing them to provide financial aid to deceased vicars' families. This novel system spread in the 19th century, providing partial mitigation of financial risk. Politicians soon realized that providing insurance for the poor promoted social stability. The welfare state was born, aiming to minimize financial risk through policies such as universal healthcare and free education. However, high taxes and universal coverage raised concerns about decreasing incentives to work and save. Some governments have attempted to dismantle parts of the welfare system to encourage people to take financial risks, and individuals now face choosing between expensive and uncertain private insurance or relying on the shrinking welfare state. Ultimately, both private insurance and the welfare state have limitations in minimizing financial risk and uncertainty, leaving individuals to navigate this complex landscape on their own. Clash of politics and finance. Governments' push for homeownership may have unbalancing financial consequences, as seen in the subprime lending crisis that shook the world's financial system. The political goal of widening property ownership led to the deregulation of the U.S. housing market, which turned out unsustainable. Subprime loans, once promoted for ethnic minorities and risky borrowers, were repackaged and resold across the world. When the borrowers began defaulting, the house prices fell, and institutions were left with worthless debt. The 2008 financial crisis is a prime example of how political decisions can have dramatic financial repercussions.
The Ascent of Money has provided a compelling journey through the history and intricacies of the global financial system. It highlights the importance of trust as the foundation of money's value while showing how credit creation has revolutionized human progress. The development of the modern financial system, along with its interconnected institutions and markets, has allowed societies to prosper or flounder based on their efficiency. Access to credit plays a pivotal role in alleviating poverty, and the irrationality of human nature is reflected in the system's imperfections. Furthermore, the complex relationship between politics and finance is illustrated by examples, such as the real estate market crash of 2008. Overall, this book summary has offered a comprehensive understanding of significant points and their relevance to the broader message of the Ascent of Money.